Real estate, the key to financial freedom and the path that has created 90% of the world's millionaires over the course of the past 2 centuries. It is a fun and fascinating concept to become a real estate mogul who has built a massive real estate empire by actively and passively investing in real estate, but how much does the average investor actually make from rental property? In today's video, we're going to talk about just that. First, we'll talk about different types of rental investing, then we'll talk about how to calculate different rates of return, and then last, we'll sum it all up by talking about how much income rental property should be producing for you. And if you're new to my channel, my name is Scott. I've been investing in real estate for about 10 years now, and I have experience with long-term rentals, short-term rentals, and commercial rentals. So I'll be relying on that experience today to break down what this rental investing game really looks like behind the scenes. So let's get right into it, but really quick, if you guys wouldn't mind, if you could just hit the like button for me down below, that would really help to support this video and my channel, and I'd really appreciate it. So first, before we get into the returns, let's talk about the 3 different types of rental investing. And this is a topic that I've talked about extensively in previous related videos, so I won't spend too much time here, but it's important to understand your options before we talk about returns. And the first and most common type of rental investing for the average retail investor is residential long-term rentals. This is the idea of owning a house or a condo or a duplex or a fourplex and renting it out long-term, usually for 1 year at a time or more. Hopefully the rent payment is enough to cover your mortgage and all the other associated expenses that come with owning rental property, and the money left over at the end of every month is called your cash flow. Next up is residential short-term rentals, and this is the idea of taking your house and turning it into a mini hotel and renting it out on a site like Airbnb to guests for a few nights at a time. You will almost certainly make more money with short-term rentals compared to long-term rentals, but they also come with a ton of extra expenses and headache. And then your third option is commercial long-term rentals, and this is my personal favorite. This is the concept of owning commercial property like multifamily or storage or industrial or retail or office, and then renting it out to businesses long-term, usually for 5 years or more. There are other ways to make money with rental real estate, but these are by far the most conventional and the most common. Next, let's talk about the 1% rule, and this is just a really simple rule for quickly evaluating whether or not a rental property is worth taking a closer look at. The rule simply states that the income that you earn every month should be equal to or greater than 1% of the purchase price. So if you're looking to buy a property for $350,000, then to meet the 1% rule, that property should be able to fetch $3,500 per month in rent. This rule just gives investors a quick understanding of the cash flow, and it also gives them a boost of confidence that the income that this property that they're looking to purchase creates is enough to cover all of the associated expenses with that property. But to be honest, the price of real estate has gone up so much in most major markets that this 1% rule is very challenging to achieve in real life anymore. For example, in my market, a rent-ready single-family house is going to cost you about $550,000. That same house, if you were to list it for rent, would only fetch about $3,500 in gross monthly rents. But in order to meet the 1% rule, a $550,000 property should bring in $5,500 in monthly rent. So this doesn't mean that long-term residential investing is a bad idea in a big city. It just means that you need to be comfortable with lighter cash flow and thinner margins in hopes for the property appreciating more over time to make up the difference. Now let's talk about cap rate and cash-on-cash return, which are the 2 most common formulas to evaluate the performance of a rental property. And it can get pretty confusing when you compare these 2 formulas side by side because there's a lot of similarities between them, but I'll do my best to differentiate the 2. So first, let's talk about cash-on-cash return, which is just very simply the amount of money that a property will make you per year before taxes divided by the total amount of money that you have invested into the deal. So for example, let's say you buy a house for $300,000, you put 20% down, which is a $60,000 down payment, then you rent the house out for $2,500 per month. Your total expenses on a deal like this will be about $1,700 per month, and that'll include your mortgage, your taxes, your insurance, your repairs and maintenance, your gas bill, and your landscaping. So that leaves you with about $800 per month in net cash flow, or $9,600 per year. Now to get your cash-on-cash return, you take that $9,600 in annual income, you divide it by your total money invested of $60,000, and you get a cash-on-cash return of 16%. That is a very healthy return on your money and almost doubles the performance that you'd see if you put it into the stock market. All right, so now that we've defined cash-on-cash return, next let's talk about cap rate. Cap rate is a formula that's most commonly used with commercial property, and it's actually usually used more as a barometer to determine how much a property is worth instead of how much cash flow it creates. Cap rate is calculated by taking the net operating income and dividing it by the market value, and this also assumes that you're buying the property cash, so there's no mortgage payment. So in our prior example, we had a mortgage payment in that example of about $1,100 per month. So if we take that mortgage payment and add it back into the deal, we get our $9,600 per year, plus the mortgage payment, which equals $22,800 per year of net operating income. Now to get our cap rate, we need to take that $22,800 per year of net operating income, we divide it by the purchase price of $300,000, and we get a cap rate of 7.6%. And again, this formula is usually better used for negotiating the purchase price of a commercial property, because let's just say that the going cap rate in your area is 8%. If you take that $22,800 net operating income on the property, you divide it by the 8% cap rate, that gives you a value of $285,000. So it gives you good reason to get a discount on the property and justify why it's not worth the asking price of $300,000. And it's easy to determine these figures when you're negotiating a deal on a commercial property, because most of the time these properties already have tenants and leases in place. So that whole topic is a doozy, and I know I just covered a lot, but I hope it all made sense. And if you have any questions for me, let me know about it in the comments below, and I'll do my best to answer everybody. All right, so we just talked about a lot of stuff, but what does it mean in real life numbers for the average investor? To put it simply, it's going to vary greatly depending on what market you're in, but if we buy that $550,000 single family house that we talked about earlier that you can find in my market, then you rent it out for $3,500 per month. After you pay your mortgage, your taxes, your insurance, your landscaping, and your gas bill, you're gonna be left with about $1,200 per month in net cash flow, which is about $14,000 per year. That deal would require you to put $135,000 down for your down payment and your closing costs, which is about a 10.6% cash on cash return. So maybe you don't have $135,000 to invest, but you do have $50,000 that you'd like to invest in a smaller property. Applying that same 10.6% cash on cash return that you can expect to get in my area, your $50,000 investment will create about $5,300 per year in income, or about $441 per month. And the cash on cash returns on commercial properties are similar in my area, where the cap rates are at about 6 or 7%, but the cash on cash returns are between 8 and 10%. These numbers are pretty strong, and you can find similar numbers in most big cities, but if you invest in smaller cities, you're probably going to find more affordable properties and even better returns. And before anyone calls me out in the comments below for not talking about some very important expense line items, let's do that now. There are 3 additional big expenses that are associated with owning rental property that are not guaranteed but you should save for, and those are repairs and maintenance, property management, and vacancies. The repairs and maintenance is just ongoing landlord responsibilities like fixing leaky faucets, fixing clogged drains, dealing with electrical issues, and things like that. The property management fee is only an expense for investors who are looking to outsource that property management to a professional company. Those companies handle all the tenant calls and collect the rents, but they charge 7 to 10% of the gross income in property management fees, so most smaller investors choose to just self-manage. And then the vacancy factor is just something that you need to budget for, because if you think about when a tenant moves out, there might be about a month or so between when they move out and when the next tenant moves in, so you need to make sure that you have some savings set aside for that. So that wraps up the cash flow topic. Now let's sum this all up before we close the video out. Now I do want to say that I did oversimplify some of the concepts and numbers in this video just to make it a little bit easier to follow, but all these principles should apply to you no matter how big or small of an investor you are, no matter what market you're in. And making 10+% on your money is a very good return. It's better than what the stock market can do for you on average, and that's one of the many reasons that I love rental property. But to top off the cash flow benefit, which was the primary focus of this video, there's a lot of other great reasons to own rental property, like appreciation, depreciation, and then principal paydown. So when you combine all the collective benefits of owning rental property, it's not unreasonable at all to think that your money could be growing at a pace of 20% or more per year. I hope I was able to shed some light on this loaded topic for you guys, and as always, if you have any questions, please just let me know about it down in the comments below. And if you haven't already hit subscribe, I don't know what you're waiting for if you made it this far, so go ahead and hit the subscribe button now to follow along with my weekly videos. And then one last reminder to just hit the like button if you haven't done that as well, because that'll really help to support this video and my channel. But that's all I've got for you guys this week, so until next week, see ya!